In this example video, we're going to look at brief exercise 817, and we're going to be talking about how to structure a special order problem, basically making the decision of whether or not we should accept or reject a special order. So they tell us that the Harrison Ford Company has been approached by a new customer with an offer to purchase 10,000 units of its model IJ5 at a price of $5 each. The new customer is geographically separated from the company's other customers, and existing sales would not be affected. Harrison normally produces 75,000 units of IJ5 per year, but only plans to produce and sell 60,000 in the coming year. The normal sales price is $12 per unit, and unit cost information for the normal level of activity is as follows. And then they also tell us here at the bottom that the fixed overhead will not be affected by whether or not the special order is accepted. Remember, this chapter is all about relevant costs, so those costs that differ between alternatives. So they're telling us that our fixed overhead, no matter what our decision is, whether we accept that special order or reject it, is not going to change. We're going to have to pay that fixed cost regardless. So that makes it an irrelevant cost and therefore is not going to factor into our decision in this situation. So we look to our relevant cost. So that first relevant cost is the price that this company is offering us for this special order. So they're offering us $5 for each one of these 10,000 items of IJ5. We normally sell it for $12 per unit, but the good thing that they've noted here is that we do have excess capacity. It's in no way affecting our existing sales. We don't have to stop selling to our normal customers in order to accept this special order. We normally produce 75,000, we only plan to produce 60,000, so we do have the excess capacity to take on that additional 10,000 units in this special order. When we look at our relevant costs, we know that we would have to spend $1.75 per unit in materials. We know that we'd have to spend $2.50 in direct labor, and we'd have to spend $1.50 in our variable overhead. So if we were to accept this special order, given that they're only going to pay us $5 per unit, that means we would actually lose 75 cents per unit on this item. So we would want to reject the special order because they're asking to buy 10,000 units, and we would lose 75 cents on each one of those, which means that it would have a negative impact on our operating income. So it would reduce our operating income by $7,500. Now, we're just looking purely at the numbers. So we're looking at the cost value to this, and it's actually going to cost us $7,500 if we do this. So we want to reject that order. However, they do mention something in the information provided. It tells us that the new customer is geographically separated from the company's other customers. So this would be something that companies would actually take a look at and see, well, if they're separated from all of our other customers, is this a new market that we could break into? Are they going to be a reoccurring customer for us? Could we have the opportunity to have a greater amount of sales in this region that we don't typically have? And if that was the case, they might be willing to take that $7,500 hit this year in order to expand the possibility of their revenues in the future. But for our sake, we're purely looking at the numbers here, and based off of the information of losing 75 cents per unit, we would reject this special order.